the value of that portfolio has increased by 4.6% over those 3 months.
That is correct.
Why is that an insane number?
So if you annualize that, that would be like 20%, which
Yeah.
is just like a stupid number for a balanced portfolio. And what I would say to our clients is great when we can get it, definitely not where we expect things to be long term.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today, our quarterly update.
We are back in your life with your quarterly update. Now, this podcast obviously goes out to a lot of people. We also use this episode for our investment clients.
Yep.
So they might have $500,000, few $1 million with us. We provide an update on how our returns are going and how the market is. So Mike, this is for the quarter from the 1st of July till the end of September.
Yep. And on this one, we'll cover off how the funds are performing, a little bit about the market, and then maybe a little bit about what we think is going to happen in the next quarter.
Cool. So a nice headline number is a balanced portfolio return because it's kind of in the middle where probably a lot of people's risk profiles sit for the most part. 4.6% for the quarter, Michael, which is an insane number if you annualize it. Now, that is 60% in shares and property, 40% in cash and bonds.
And what we're saying there is the value of that portfolio has increased by 4.6% over those 3 months.
That is correct.
Why is that an insane number?
So if you annualize that, that would be like 20%, which is just like a stupid number for a balanced portfolio. And what I would say to our clients is great when we can get it, definitely not where we expect things to be long term.
Yep.
I would expect a balance. Generally, the way portfolios work, people are always like, what return am I going to get, blah, blah, blah. And it's kind of like, well, it depends. The way I usually explain it is you've got the cash rate, then you've got conservative, that's probably 1% higher. And each level of risk you go up all the way to aggressive, it might be like 5% on average over the long term above the cash rate.
Yeah.
So if we go average cash rates, I'd probably go balance somewhere between like 7 and 8
over the year.
And we're going, well, this is 4.6 for the quarter.
Yeah. And what's driven that? Are we coming off some real lows and it's just kind of correcting, or is this actually not that? Are we seeing some kind of abnormal growth in these investments?
Yeah, I mean, one of the big things at the moment, there's two big things happening. Like the US economy just continues to perform strongly. Yep. Obviously, we saw rates get cut there over the quarter, and the S&P 500 has gone up pretty much 100% over the past 5 years, which is just madness. We look at per asset class, and it's really strong green numbers across the board. So if I talk you through some of these numbers, like I said, global shares, a lot of that is the US market up 30%. Australian shares up 23% over the past year. Emerging markets up 19%. New Zealand equities. So give the NZX a tough time. They're up 10% now over the past 12 months, 6% for the quarter. Properties had a tough time, up 26% for both for infrastructure, and then bonds are a big component of. I do wonder and go, the share market can't keep going up at that rate.
Yeah.
Now this is not. Maybe we'll get to this a little bit later. This is not going, we're at the top of the market, you should sell all those sort of things. It's just going, you can't have those levels of returns forever.
Yeah.
One part that does help these portfolios a hell of a lot, opposed to when we were at with really low interest rates, is bond portfolios. Bond portfolios are delivering like 4% over the quarter, 10% over the year. And that's both for New Zealand fixed and global fixed income.
Yeah. And one of the reasons that'll be happening for the bond portfolios is the value of bonds or bond performance has an inverse relationship to the official cash rate. So as the official cash rate comes down and interest rates also come down, bonds that have been locked in at previously higher interest rates will start to be more valuable.
Part of me goes like, when it comes to just like interest rates dropping, like economy is just that simple. Like interest rates are starting to come down in. So obviously the RBNZ is now down 75 basis points. ECB is down 25 basis points. The Fed dropped 50 basis points. It's getting people to get a little bit excited, right?
Yeah, and I think that's natural, right? It's been a cold winter for a couple of years. People have been sitting on the sidelines, and it's a really important thing when we're talking about the markets and economies is most of them are forward looking, and a very important distinction that the economy is different from the markets. but markets are definitely forward looking. So the sentiment of things changing and the expectation that things will change in the future can be enough to kind of kick off those markets early.
Yeah. Do you want to guess the worst performing asset over the quarter, Mike?
Or gold.
Cash. I actually don't have gold in this.
Yeah.
Cash has been the worst performing asset class. Now, there's been a lot of people for the last few years going, I'm just going to stick money in term deposit. Cash rates are really high, especially while everything is dropping. This is just a really good reminder that, cash in line with inflation pretty much, that it's not where you want your money to be if you are thinking about the longer term. Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below. So we've talked a little bit about portfolios, the balanced portfolio, and some of those kind of key drivers that are making that growth happen. What else are we looking at? Yeah, so if I look at over our portfolios over the past, say, 12 months, a defensive portfolio is at 13.5%. A balanced portfolio is now sitting at 16.2%, and a pure growth portfolio, which is pretty much just all in shares and property, is sitting at 21%. One interesting thing is those numbers are quite crazy. When you actually roll it into 3-year and 5-year numbers, they start to look a lot more normal. Yeah. Which, like, I've done a few reviews with clients over the last couple of months, and you look at their 1-year number and you go, that's like crazy good. You roll it over 3 months and it's pretty much like the growth has all come in the last 12 months. Yeah. And that's just the reminder that, we go through good times, we go through bad times, and things average out over the long term. So, those numbers were very high. If we look over 3 years, defensive at 2.9, growth at like 5, pure growth at 5.5. If we look 5 years, pure growth at 8.6. Balance at 5.7, defensive 3.4, much more normal numbers, especially when we're starting to think about 3 and 5 years. That's definitely where bonds in particular were very low. Yeah. Cash rates over 5 years were very low. Yeah. I think we get a little bit confused when we're thinking about like term deposits and going, term deposits are at 6%, but they're priced right now while bond performance is over a historical period of time. Yeah. And again, those long-term averages, things do look a bit more normal. So I don't think when people are looking at these returns, they should be freaking out about anything. And again, you shouldn't be making decisions based on short-term performance. Long-term decisions is what we're looking at. 100%. So the question is, right, going, well, these numbers, because the thing about like human psychology, people look at these numbers and want to jump in. They'll go, these are amazing returns. Yeah. Here's my money, James. Go make me 18%. And it's that counter-cyclical investing, which is so hard to do, but really you should have been doing this 2 years ago. Now, the question is, if you've got cash now, what should you be doing with your cash now if the markets move so much? My advice would still be to invest now, because timing the market is just such a sucker's game. Like, granted, if things are low, beautiful time. If they're high, there has been many points in history where people have gone, we're at the top of the market, I'm going to sit on the sideline, and they have been punished significantly. So I would say if you've got cash to invest, you deploy the money. We have no idea what's going to happen with the market over the short term, but over the long term, we know we will get those averages that we've seen. Yeah, 100%. And let's say we've got people in the funds at the moment seeing this performance thinking, this is great. I'm expecting this quarter on quarter. What can they kind of expect for the next quarter? What are you thinking? Yeah, look, the US market has moved a lot. It'll be interesting to see how the election impacts markets. I would have thought not much happens between now and then. I mean, you look locally and you go, we're feeling very good about 2025 and beyond. You look at the states and you go, they've had some pretty good growth. The question is, can they sustain the growth? Yeah, I think if inflation stays where it is, I mean, US inflation's kind of jumped a little bit. If inflation stays where it is, interest rates continue to come down. That is obviously good for markets, good for bond performances. Yeah. So basically, what we're saying is there's a lot going on out there in the market at the moment. Yep, we may get similar returns next quarter, or they may be a little bit less. However, we shouldn't be making decisions quarter on quarter. These are long-term investments that you should be hanging on to.
Yeah, and look, I would love it if every quarter was like this. It'd make my job bloody easy, but it's just not reality. We take them when we can get them. Really, markets are up 10%, markets are down 10%. Your reaction should be the same, which is nothing.
100%.
Awesome. Okay, so also along with this podcast today, we'll have a newsletter coming out for our clients in terms of performance of portfolios. Any questions, please reach out to your financial advisor. Otherwise, we will catch you at your next financial review. And for all our podcast listeners out there, hope you have found this episode very educational about what is happening in the world at the moment. Much love to Partners Life. Make sure to subscribe to the channel, give us a review, give us a like. We'll catch you next time.
Cheers.